For 90% of its history, the stock market is a slow, methodical compounding machine. You invest, you wait, and your capital gradually grows over decades. But every few decades, a rare outlier event disrupts that timeline. We call these leaps, moments where technological acceleration compresses years of wealth creation into a much shorter window. We saw this with the commercialization of the internet in 1995, and again during the mobile revolution that followed. The rapid integration of artificial intelligence into the global economy represents the latest verified historical leap. Recognizing this window early changes an investor's timeline, allowing for capital growth that the standard compounding route cannot match. Many investors remain sidelined because they fear AI is simply a repeat of the 1999 dot-com bubble. In 1999, capital flowed into companies with zero enterprise value or actual revenue. Today, AI is being deployed by established leaders to solve specific enterprise problems and increase operating margins. The financial data tells a different story. At the height of the 1999 bubble, the market PE ratio hit 33. Today, the AI-driven market sits significantly lower, at 24. The growth trajectories are also distinct. The Nasdaq surged 400% during the dot-com run, while the current AI cycle has only produced 120% gains so far. Current tech leaders are generating record levels of free cash flow and profitability. This cycle is built on a foundation of earnings that the startups of the 90s never possessed. The primary risk in this cycle is misplacing capital across the wrong layers of the ecosystem, rather than a total systemic collapse. We can organize the market into a framework based on risk and potential upside. The infrastructure layer is the starting point. Semiconductor companies providing the computing power for AI. NVIDIA, TSMC, and ASML function as monopolies, owning the machines to build the AI engines. This strategy provides foundational exposure to the sector. You are betting on the essential hardware with very low business model risk. However, because their dominance is widely recognized, these stocks are often priced for perfection. This limits their room for the kind of rapid, multi-bagger growth seen in earlier stages. This layer is the destination for capital that prioritizes certainty and baseline participation in the AI cycle. A pricing gap occurs when a company's fundamental quality is rising, but its stock price is stagnating. We see this currently in the cloud and data center layer, specifically with Microsoft and Amazon. Both businesses are seeing deep AI integration, expanding margins, and decreasing PE ratios, even as their stock prices face short-term resistance. The trade-off here is the sheer scale required. Because these are multi-trillion-dollar companies, an investor needs significant initial capital to see a meaningful impact on their total net worth. Finding gaps in these behemoths allows you to balance aggressive exposure with the safety of some of the strongest balance sheets in history. The highest potential for growth sits in the application layer, where companies develop specific software and advanced robotic solutions. Palantir is a prime example of a pricing gap in this space. Despite 70% revenue growth and a dominant position in B2B scaling, the market has frequently left the stock trading flat. Tesla represents another misunderstood gap. While the market focuses on vehicle sales, the company is pivoting towards autonomous energy and humanoid robotics. The trade-off is the heavy skepticism surrounding these pivots. This negativity actively suppresses the price, which creates the opportunity but also the volatility. Other opportunities exist in software automation, where companies like UiPath are building AI tools to handle repetitive enterprise tasks. Holding these stocks requires significant research. You have to understand the technology well enough to ignore the noise during market downturns. Contrarian positioning and the ability to ignore market sentiment are the entry costs for those targeting the upper limits of this cycle. The final category is the most dangerous: pure hype companies and AI wrappers. These attract beginners because they have low share prices and exciting narratives, but they lack the cash flow to sustain themselves long-term. These companies often see brief portfolio spikes, followed by a total loss of capital as the hype fades. Protecting your capital from these traps is just as important as finding the right companies in the infrastructure or cloud layers. This framework helps you align your portfolio with your specific goals and risk tolerance. Path A is for the risk-averse. You focus on the infrastructure and cloud layers, prioritizing safety and monopolistic dominance over high-risk growth. Path B is for the active optimizer. You target pricing gaps in the productivity and robotics layers, accepting higher volatility for the chance at maximum returns. Path C is for the passive investor. You simply buy the S&P 500 to ensure you participate in the AI leap over the next decade, without the stress of picking individual winners. As we saw with the dot-com era and the mobile revolution, most participants will either lose capital to hype or stay sidelined by fear. A small group of investors will succeed by learning to distinguish the actual technology trend from the price of the assets themselves.